I cannot believe that it has already been a month since I made a video titled, I love out of the money options. And that's the reason why I love being an option seller, is because time goes by way more quickly than we think it does. So by utilizing the strategy of selling call options and selling put options, I benefit from the passage of time. What I want to do today is give you guys a glimpse of my actual portfolio online so you can see exactly how much money I made off of selling the options that I sold in the last couple months that are going to expire today. Now, before you guys get crazy and start thinking, holy, this is so easy to make money, I do have a bit of a caveat with this. These are only portions of the strategy. So when you're looking at these individual lines of profit, you're going to see, one of these lines has like an $800 profit. In fact, that line, $800 profit, is actually sitting right now with the other option that I'm trading with it, has a loss of about $1,000. So I'm actually down around $200 on that particular trade right now. And I just wanted to let you guys know that this is a strategy that you have to use over time, and if we build the skills, we can actually benefit from growing our money over time. But today, the options that are expiring that we're going to look at are all out of the money. Now, for those of you who don't know what out of the money is, I'm going to show you exactly that in this video. But first, what we're going to do is we're going to look at the actual account. So here's the account, and what we're going to look at, we have a Celgene call. It expires today. And you can see that the current price is 5 cents, which means that if I chose to buy it out today, it would cost me $5 to buy it. I short sold this, which means I have a negative quantity in my account, -1, which is representative of 100 shares trading at $95. Originally, when I sold it, I collected $234. Today, I'm going to let it expire. If we look at this trade right now, Celgene, the bid and the ask on the stock is $78.87, $78.89. So it's trading well below the $95. A call option is out of the money when the price of the stock is below the strike price. In this case, $78.87 is below the strike price of $95. Let's look at the next one. It's a put. So puts are opposite. I short sold again, -3 option contracts, which is the equivalent of 300 shares of Costco at $190. I originally collected $818 for this, and the market price is currently $9. If we click on trade, we'll see the current price of Costco is $198. Because this is a put, the out of the money options are the ones above the strike price. So $198 is above the $190 strike price. Now let's look at 2 more calls. So we know that this is a call. It expires today, May 18th. In order for it to expire out of the money, the value has to be below $28. So let's check the price of Rubbermaid right now. And it in fact is below 28. $26.29 is the current price. It is below $28. So that is going to expire out of the money. And all this means is that it literally is going to expire. The option contract can't get exercised because there's no value. There's no reason that somebody would buy shares from me for $28 when they can just buy them on the open market for $26.29. It makes absolutely no sense why someone would pay more for a stock from me if they could just buy it for cheaper on the open market. That's why it's considered out of the money. And that's where we like to be as call and put sellers, is we like to actually be out of the money. Let's look at this last one. Now Starbucks, again, -3 positions. The strike price is $60 and it's a call. So because I've sold it short, because this price is $60 and because it expires today, I want the Starbucks value of the stock right now to be under $60. If it's a call, we want it to be below. So let's click on trade and we'll see the current price of Starbucks is around $57.23 and the strike is $60, which means, again, out of the money. On Monday, when I open my account, all of these positions will have a 0 in them, so they will just expire worth nothing. And I will have realized the full gain of the book value. So whatever this book value is will be the profit. Now the big thing here is I didn't know that these prices were going to be exactly where they are, if they were going to be above or below the strike price. But I used statistical data to be able to tell exactly the range that a stock is likely to be in. And then we use that statistical data to check against the amount of premium that we're going to collect, or the amount of money that we're going to collect, to see if it's worthwhile taking on that risk. So let's take a look at the charts to see why I made those decisions at that time. So this first stock is Celgene. Now I entered this trade on March 23rd. I collected $234 for this trade. The stock had been trading and downtrending. Of course, using statistical data, I was able to look at this and determine what was an optimal strike price. We're going to get to that later in later videos, but for now I just want to show you kind of what the chart actually looks like. So the target price on Celgene, the strike price that we determined, which is good, was going to be selling a call at $95, which means we basically wanted the stock to end up somewhere in this range, below $95, for the maximum return on investment. Let's look at what actually happened. The stock started to rally up a bit, but ultimately they've had some bad news recently. They're getting sued. There's a class action lawsuit against Celgene, and the stock is actually headed in a downward direction. I'm pretty bullish on Celgene in general, so I believe that this is going to return up over $100. I'm going to hold into my position that I'm in, but for now I am selling calls against it to get some of the cash back against the puts that I have. So this $95 mark, we wanted it to be below there, and of course it is below the $95, so this was a great trade. We'll look at Newell before we look at Costco. The strike price was $28, so we could see that this stock was having a little bit of a rally, and it was coming up here, and it wasn't that long ago I placed this trade in on May 8th, and the goal was for this stock to end up under $28. So let's see where it went. And of course it had a slight correction, and I've collected the maximum premium. Starbucks, same thing. We're seeing a little bit of a rally, and the strike price that I set, so we've made this sale on April 23rd, and the strike price anywhere in this range below $60. You can see it hadn't been at $60 since back in January. It's likely that this stock is going to come back up and get really close, but it is going to trend somewhere in this range if we continue with this chart. And let's see how it did. It corrected actually downwards, and which is exactly what we were speculating, and we've got this well within our range of the $60. Now let's take a look at Costco. I said before that the trade expiring today, I'm profiting about $800, and I also said I had a call option that I was pairing this with that I'm down about $1,000 on. So if we look way back at the beginning of this chart, prior to December, I actually had a position on, I had a call that was on that was at $173, which means that I didn't want the stock at that time to go above $173. You can see that we had a huge breakout here, and it has gone upwards well above my 173. So I'm actually managing that $173 strike, which is a call option, and I want it to be below that price by moving it out in time. So I've been selling month after month. I've been buying it back for a lot of premium and then selling it for slightly more premium, each time collecting a bit more money. But I have this line down here at $173, and in order to take maximum profit, I actually need this stock to go all the way underneath that. So what I've done is I've brought my put option that was well down, it was down at like $160, and I've actually driven it up in time. So as this stock has risen, I kept the call stagnant to be my upper limit, and the put I'm actually raising up with time. In April, the put that I had on that was at $180, it expired, and I had to make this decision. I had to move it up. So I moved it up, the put, to this 190 mark. To maximize the profit on the put, I want the stock to be above $190. In my ideal world, for me personally, I actually want it to be between 173 and 190. That would be my optimal range to see a bit of a correction. But at this time, when I made this trade, April 23rd, there was no indication that it was going to downtrend. We were going to see an uptrend on this stock and was going to end up somewhere above, likely above 195, but I was playing it safe and actually put in my trade at 190. So let's see what it actually did. And of course, it continued to trend up. Had I put in the price at 195, I would have actually made a little bit more money, but I'm happy today at 198. It's expiring above 190. I will collect my premium and then I will reopen this on Monday, probably again 1 month further in the future at $190. This is part of the management. This is kind of what you learn over time, how to manage these trades. And you can see how easy it is to start to look at the trends and see whether or not this stock is going to be above or below a certain price and be able to make a little bit of money off of that. Well, I hope this gives you a little bit of insight into kind of how I'm placing my trades, the quantity that I'm putting my trades at, and where the strike prices are and how they might work. Let's get rich together. See you soon.